So we are quite excited about emerging markets. The stars seems to be aligning together. We've got, first of all, cheap valuation across, I think, all of emerging market equities. And at the same time, we've had various forces which will lead to long-term devaluation of the US dollar, which is actually very positive to emerging markets. The first point is that the valuations of these markets are very attractively valued. They, despite the reasonably good performance last year, is still at around multi-year lows in terms of valuation. So that's a good starting point. And going forward, these companies within these emerging economies are continuing to grow, especially the high-quality ones, and we're able to get into these opportunities at attractive valuations, way cheaper valuation than developed markets. I guess this is very counter-consensus in terms of how people tend to look at China and US relations, because last 8 years of experience. This alone, I think, can actually improve or remove some of the big headwinds as a result of the funds flow from foreign investors. However, we believe that the wind's turning with the currency changes, and after years of sort of underperformance and sort of outside of the radar of a lot of investors, the valuations of these markets are very cheap. The way to make good returns is when the valuation's cheap, and also when it's sort of outside the attention of investors. We're particularly interested in regions which has got strong sort of macro underpinnings, as well as cheap valuations. And the key markets that we like are places like China, Vietnam, and Indonesia, and to some extent India. When we look at other markets like Vietnam and Indonesia, the stories are somewhat similar in that they are not small countries, 100 million to 300 million population. And they're growing their economy 5 to 10% in real terms. The valuations on the market are very cheap, and they also benefit from this China plus one offshoring opportunity. As we know, with the trade situation between China and US, a lot of the lower cost, lower sort of end manufacturing has already moved to these markets, and will continue to do so. These countries also have a lower cost of labor. So we believe, the competitive strength is strong, even if, tariffs goes up a little bit. It's just hard to find replacement for them globally. They're just not going to make these things in the United States. It's too expensive, even with tariffs. So we believe that those markets are interesting. The reality is, in a lot of these countries, particularly those in Asia, they have done years of reform to actually make the place a better environment to do business. The Chinese market has been volatile. We believe that it's been, the headwinds has been twofold. One is the domestic property market adjustment, and the second is the geopolitics between China and US, which has impacted funds flow, particularly into the Hong Kong market, which is a market that foreign money and also local money invest in. We believe that both these headwinds could potentially are turning for the better to be even a tailwinds. The property market is clearly turning around after a big adjustment after the last 3 or 4 years, particularly in the top tier cities. So this should actually help economic activities in China. At least the property market will be less of a drag to growth as of than last few years. In terms of geopolitics, the reality is this. Despite last 7 or 8 years there's been a lot of pressure on already in terms of tariffs and various actions in the ways of sanctions and the like from the US to the Chinese companies, and in some cases individuals. So that's been negative to fund flow and also to confidence. However, if we listen to the utterances from the incoming administration in the US, it seems like that government is much more locally focused in terms of how to improve that economy through to reducing cost in the federal government budget, and also maybe strengthening the domestic situation. And if we really pay attention, the tone towards China had been actually rather conciliatory. Things like inviting the Chinese president to attend the inauguration in January, and also to saying that China and US can solve all the world's problems. And so in terms of tariffs, we are likely to see some watering down of those initial expectation of the tariffs. And in fact, we are seeing some signs of that already. So given the high interest rate already that's in the system, that should slow economic activity at least incrementally. At the same time, we will see likely a watering down of some of the tariff threats that the US government is telling the rest of the world is going to apply. So both of these are likely to lead to some weakness in the dollar at a currently very high level. Look, I mean, in this, these economies are reasonably mature economies. We focus particular thematics within these markets, and really we're very much focused on the artificial intelligence, AI theme in these sectors. The reality is this: I mean, a lot of the advanced semiconductor manufacturing are taking place in these countries. In the case of Taiwan Semiconductor makes all the latest chips for NVIDIA, chips for Apple, chips for Qualcomm, so inside the smartphones and the like. No one else in the world can make their products, and their earnings will grow very quickly, especially with the introduction of, broadening of these AI devices all over the world. So we like their valuations very attractive. And in terms of Korea, we are focused on the memory makers. Companies like SK Hynix. It produces the latest memories for all these AI models, which the AI companies use. Literally, more than 50% market share globally. So when people are so focused on NVIDIA, but actually NVIDIA has to buy a lot of these chips from no one else but SK Hynix to support the AI effort. And this company is available on about a 5 times price to earnings multiple. So there are others, but these are the key names that we're focused on. These are good long-term global themes. We believe AI is just starting to broaden out in terms of applications. So it's early days. And these stocks are available on extremely attractive valuations. Well, so we have been a little bit careful in markets like India. I mean, it's long-term, it's a great long-term growth story, reforms done there, so no problem with that. But it's just in the near term, the valuations for the Indian market has gone up a lot. It's been basically, in recent years, it's been one of the very few EM markets, equity markets that actually has done well. The valuations, there are some growth stocks there growing at 5%, but they're on 70 times PE. So they actually are very expensive, and recent numbers from various companies and also macro numbers are showing somewhat of a slowdown in that economy. So the market sort of actually not taking it very nicely. A combination of expensive valuations and slowing fundamentals. So I think one should be a little bit careful when one looks at India. But long term, if the valuations comes up enough, definitely something to look into. I think that really the starting point and the point to make is that the starting valuations for these markets are very, very attractive. It hasn't done well for many years, but it seems like it's starting to turn, and really it would not take much for the performance to improve. And the second is, in a world where economic growth is in short supply, there's actually an abundance of growth in these markets. And then within that, there are lots of good quality companies which will become local, if not global champions in the next 3 to 5 years. So we believe that by owning these high quality businesses with strong economic moat, cheap valuations, long-term performance should be underwritten by the earnings growth. And if we get actually a re-rating for these markets from the very low level at the moment, that's the bonus that we'll get. So these markets are prospective. It's good to be selective and choosing the better companies within these markets for long-term reward.